The European Union's economy may be the market's main macroeconomic preoccupation in the coming week, because the latest instalments of two monthly surveys are due out, and they're both due out on Monday the 26th of September. The first is Germany's ifo Business Survey, and that will offer insight into the EU's single largest economy. In August, the reading was 88.5. Now that represented the third monthly decline in a row, and it was a big drop from the year before, when the ifo read 99.5. And in fact, it was the lowest score since June 2020, when COVID-19 was the biggest issue facing the German economy. Now the big issue is the price of oil and especially gas. The good news is the Dutch TTF gas futures price, which you can track for free on the internet, has almost halved in the past month, from €347 to €188 per megawatt hour, perhaps helped by news of improved German gas storage levels, the EU's initiatives to cut power usage, and also the European Commission's €140 billion windfall tax and energy caps and support programme. That said, the record of windfall taxes and price caps working for long isn't good, at least if history's any guide, and the Dutch TTF gas futures price is still 6 times higher than it was a year ago, and more than 12 times higher where it was in 2020. So the EU and Germany probably aren't out of the woods just yet. It'll therefore be interesting to see what German industry thinks of all of this, and whether it's taking heart from the EU's policy initiatives or not. In this respect, the ifo headline figure for current conditions will be interesting, but the expectations index may be more telling. Note how that measure is sinking a lot faster than the current conditions reading. An August score of 80.2 was the lowest reading since April 2020, again when COVID-19 was really getting going. The second survey to note comes from the National Bank of Belgium, and this is the courbe synthétique, or synthetic curve. Now, before you all start scoffing and asking questions about how many famous Belgians you can name, do note that the courbe is, if history is any guide, a respectable steer as to where Europe's Euro Stock 600 stock market benchmark might be going. Now, we have to accept the past is no guarantee for the future at all, but for whatever reason, a few thousand Belgian industrialists do seem to have their finger on the pulse when it comes to how Europe's economy is doing and what its stock markets may or may not do. In August, the courbe's reading slipped lower to minus 5.8. That was the fourth drop in a row, and it compared to a reading of plus 7.6 in August the year before. It was also the lowest reading since January 2021. On the domestic front, there's a fairly lengthy list of scheduled corporate updates, although the bulk of them are first half and interim results, and most of them come from small and mid-cap companies. Just one FTSE 100 member is due to provide any sort of update to shareholders. Nevertheless, it should have been an informative week, and names which could be worthy of further research include the following, although again, some of these dates could yet be subject to change at the last minute. Finsbury Foods on Monday the 26th of September. Then we've got, on the 27th, fizzy drink specialist AG Bar, S&U, Saga, Card Factory and Next 15 Communications. James Halstead, Boohoo and Dignity on the 28th. Trufin and Bango on the 29th. Before Carnival, HSS Hire and Go Ahead Group are due to round out the week on Friday the 30th of September. However, the company which could just cause the biggest fuss in the week ahead may well be the sole FTSE 100 firm that's due to speak, and that is Next. The retailer is due to release its first half results for the 6 months to the end of July on Thursday the 29th of September. This statement should be particularly interesting. Next raised its profit guidance for the full year to January 23 back in August, but since then a number of retailers, including Joules, Gear for Music, Ocado, THG, Naked Wine and the AB Foods-owned Primark, have all coughed up profit warnings or dished out weak updates, and the message has been that business really turned south in July and August. Now, you can argue Next is a very different company and one with a much stronger and more established competitive position than those that we've just mentioned, and it could well be better at placed to shake off the high street blues. But its shares are still trading a quarter below where they were a year ago and not far off the 12-month lows. Again, you can maybe say at least then the share price is already expecting a more lukewarm statement than the ones shareholders have become used to, since Next has had the knack of beating and upgrading expectations over the last 12 to 18 months, not missing them. At the first half stage a year ago, Next reported the following headline numbers: sales of £2.2 billion, pre-tax profit of 347 million, earnings per share of 227 pence. And they'll be the benchmarks by which these interims are judged. However, investors and analysts are more likely to be interested in any guidance for the full fiscal year to January 2023 looking forward from boss Simon Wolfson. Now, after a 21% year-on-year increase in full price sales in the first quarter and a 5% increase in the second, Next is currently getting to a 1% year-on-year increase in the second half, not least because the base for comparison now just gets so much tougher. Remember that a year ago, lockdowns had finally started to end. At the midpoint of the upgraded guided range from August's update, pre-tax profit for the year to January 2023 is now expected to come in 5% higher than the fiscal 2022. That's at £866 million. Next did not declare an interim dividend last year, but it did pay out 270 pence a share in two specials instead. Now, for this financial year, Next has suggested it will look to resume ordinary dividend payments, and the current consensus forecast is for a total distribution of 205 pence a share. Note that the company also continues to run a share buyback scheme funded by what it calls surplus cash, and so far this financial year it has returned £224 million to shareholders via this mechanism. I hope that you and your families are all in good health and good spirits. Thank you for listening and watching, and I look forward to seeing you again next week.